Welcome to Iron Financial. We're the channel built to help you forge a stronger portfolio and cut right through all the market noise. Today, we are putting an ad tech titan under the microscope, the trade desk. You know, for years, this company has been a Wall Street darling, a high flyer that just could not do anything wrong. But lately, well, the stock has been absolutely decimated. So we're here to answer one critical question. Are we looking at a broken stock, which would present a rare opportunity to buy a quality company on sale? Or is this a fundamentally broken company whose best days are now behind it? All right, let's get into it. Let's just start with the cold, hard reality that's causing so much pain for so many investors. From its all-time high, the trade desk stock has collapsed by a staggering 77%. Now, let me be perfectly clear. This is not a dip. It's not some minor correction. This is a full-blown capitulation. A drop of this size, it just erases years of wealth, and it shakes the conviction of even the most battle-hardened investors out there. It forces us to ask a really serious question. What does the market know that we don't? Or is the market just in the grip of an irrational panic that's created a once-in-a-decade entry point? Whoa, hold on a minute. A 77% drop sounds absolutely catastrophic, but let's add some context here. Because this isn't some fly-by-night company we're talking about. This is the very same company that, from its IPO, delivered over 1,000% return to its early investors. I mean, it was a generational winner, the absolute textbook definition of a market darling. That's exactly right, and that's what makes this whole situation so jarring. In 2025 alone, the stock is down almost 70%. So how does a celebrated leader, a champion of its entire industry, fall from grace so quickly and so violently? You know, this kind of dislocation doesn't just happen. Something is deeply wrong with either the company itself or the market's perception of it. Our job is to figure out which one it is. And that is the exact conflict we're here to dissect. To do that right, we need a disciplined, structured approach. So here's our game plan. First, we'll acknowledge the fall of this titan and just how big the dislocation is between its stock price and its historical value. Second, we're going to build the bull case by examining what I call the financial fortress, the hard, undeniable numbers of the business. Third, we'll give the bears their due and look for the cracks in the armor that have the market so terrified. Fourth, we'll do the heavy lifting and actually forge a valuation to see what the future could hold for investors at this price. And finally, we'll weigh all the evidence and deliver the iron verdict. So let's begin. Section 1, the titan has fallen. We really have to start here because we have to respect the price action. The market is a voting machine in the short term, and right now, it is screaming that there is a problem. Our job is to figure out if this is just a temporary crisis of confidence or if it's a sign of a permanent impairment to the business itself. Okay, now before we get into all the fear, we need to build a foundation on facts. In this section, we're going to examine the very bedrock of the trade desk's business. We're going to focus only on the numbers reported in their SEC filings, no speculation, no narrative, just cold, hard data. We're going to see if this company is built on sand or on solid rock. This is the bull case, and it all starts with the lifeblood of any growth company, revenue. First things first, let's look at the top line. This is where the bull case begins, and it's built on just sheer consistency. Look at this revenue trajectory. In 2021, the trade desk brought in $1.2 billion. By 2024, that figure had doubled to $2.4 billion. And in just the last 12 months, they've pulled in nearly $2.8 billion. So despite all the drama with the stock, the business itself is still expanding at a really rapid clip. This is not a company that's shrinking, not even close. This is not the chart of a company in distress. This is a powerful, durable growth engine that continues to fire on all cylinders, consistently taking market share in a global digital ad industry that's projected to be worth nearly $1 trillion. And this growth, it's not being funded by reckless borrowing or some kind of financial engineering. This slide shows what I call a fortress balance sheet. As of the first quarter of 2025, the trade desk is sitting on $1.7 billion in cash and equivalents. They are gushing free cash flow to the tune of $230 million. But the most critical number on this entire slide is right here, 0, total debt. You know, in a world of rising interest rates and all this economic uncertainty, that's a massive advantage. It's a superpower. It means they are the masters of their own destiny. They don't answer to creditors. They can invest aggressively in R&D. They can make strategic acquisitions. And they can weather pretty much any economic storm without breaking a sweat. This is financial strength in its purest form. So here's the crucial point. This isn't just empty, unprofitable revenue growth. It is incredibly profitable growth. Take a look at these margins. A gross profit margin over 80% is elite, software-level profitability. It shows they have a powerful technological advantage and some serious pricing power. More importantly, their adjusted EBITDA margin is a robust 34%. Okay, now, adjusted EBITDA is a term that Wall Street just loves to throw around. Can you break that down for us? What does that 34% margin really mean? That's a great question. For those of you who aren't familiar, think of adjusted EBITDA as a clean proxy for the core operational cash flow of the business. It strips out things like non-cash expenses, interest, and taxes to give you a clearer picture of how profitable the day-to-day business actually is. A 34% margin tells us that for every single dollar of revenue, about 34 cents is converted into core operational profit. This is a cash-generating machine. They aren't just growing, they're scaling efficiently and profitably, which is really the holy grail for any growth company. And this right here, this is the capstone of the entire bull argument. This number is arguably the most important of all of them. For over 11 straight years, that's 44 consecutive quarters, the trade desk has maintained a customer retention rate of over 95%. Okay, just let that sink in for a second. In the hyper-competitive, fast-moving world of ad tech, where new players are always popping up, their customers, some of the biggest brands and agencies in the world, they sign on and they simply do not leave. It demonstrates an incredibly sticky platform and a deep structural moat. Their service has become essential, non-discretionary infrastructure for their clients' advertising operations. That kind of loyalty is just priceless. All right, enough. Fortress balance sheet, incredible margins, sticky customers, I hear you. The bull case sounds absolutely perfect on paper. But if the foundation is so solid, then why is the stock in ruins? Why is this financial fortress under siege? The market clearly sees something that those charts don't show. You can't just ignore a 77% collapse. So let's talk about the fear. It's time to talk about the cracks in the armor. Let's just cut right to it. This is the question every single investor, every analyst, and probably every employee at the trade desk is asking themselves right now. If the numbers are this good, if the business is this strong, why is the market punished the stock so severely? The dislocation is just too massive to be a simple overreaction. There have to be tangible reasons driving the sell-off, and we need to drag them out into the light and analyze them. The fear isn't just coming from one place. It's a perfect storm of negative sentiment, what I'm calling the market's four horsemen of doubt. First, there's the concern about slowing growth, a feeling that the hypergrowth days are over. Second, and this is a big one, there's been turmoil in the C-suite. Third, Wall Street has gotten cold feet, with analysts just racing to slash their price targets. And fourth, we're seeing big money, the supposed smart money, heading for the exits. Together, these four factors are creating a powerful vortex of doubt around the stock. Let's focus on the biggest red flag first, the C-suite instability. In the world of investing, few things spook the market more than the sudden, unexpected resignation of a chief financial officer. It's the ultimate, what do they know that I don't moment. A CFO has their hands on every single financial detail of the company. When they leave abruptly, it immediately raises questions. Is there an accounting issue? Is there some major disagreement over strategy? Or even worse, has the CFO lost faith in the company's future prospects? This is not a minor issue. It's a major crack in the narrative. And that concern is not just our speculation. Wall Street is explicitly calling it out as a primary risk. Here's a quote directly from Wells Fargo's analysis stating that the CFO's resignation could lead to continued fundamental and narrative volatility. Now, when a major bank uses language like that, it signals to institutional investors that the story is unstable. It introduces an element of uncertainty that professional money managers are literally paid to avoid, and it puts immense pressure on the stock until a permanent, respected replacement is found. And it's not just the analysts getting nervous. We're seeing prominent investors vote with their feet. On February 2nd, Cathie Wood's ARK ETF, one of the most visible growth-focused funds in the world, dumped nearly 2 million shares for almost $60 million. When a high-profile investor who built their entire reputation on identifying the next big thing in disruptive innovation decides to sell, it sends a powerful negative signal to the rest of the market. It suggests they just don't see the high-growth story they once did, and that's a massive blow to investor confidence. This negative sentiment is crystallizing in the tangible form of analyst downgrades and price target cuts. And what you're seeing here is a classic example of the herd mentality on Wall Street. Look at this wave of reductions. Rosenblatt cuts their target from 64 to 53. Truist from 65 down to 60. Citi slashes their target from 50 all the way down to 38. And Bank of America cuts from 49 to 40. Now, this isn't one rogue analyst with a bearish take. This is a consensus shift. This cascade creates a negative feedback loop where falling price targets trigger more automated selling, which in turn leads to even lower price targets. It can be a really brutal downward spiral. Okay, so we've examined the fortress-like fundamentals and we've stared directly into the cracks in the armor. We understand the bull case and we understand the bear case. Now we have to do the heavy lifting. We need to forge a valuation. The stock price has been absolutely hammered, but does that mean it's actually cheap? Or is it cheap for a very, very good reason? Let's run the numbers and translate all of this sentiment and data into what it could mean for potential returns. This slide perfectly captures the sea change in how the market values this company. In its heyday, when growth was just red hot, the trade desk traded at a price-to-earnings ratio north of 60. Investors were willing to pay an enormous premium for its future potential. And today, after the collapse, that PE ratio has compressed all the way down to just 14. That is significantly cheaper than the S&P 500 average. The market has completely re-rated this stock, stripping it of its growth premium and pricing it more like a stable, mature value company. And that's the core debate right there. Does a company that's still growing revenue at nearly 20% really deserve such a low multiple? So what does this all mean for your money going forward? Well, we've modeled out 3 distinct scenarios based on different revenue growth assumptions through 2026 and beyond. In the low case, if macro headwinds persist and growth slows to around 14.4%, your annualized return from today's price is a pretty disappointing 2.9%. You're basically just treading water. In the mid case, if they meet Wall Street's current lowered expectations and grow revenue at 16%, you're looking at a respectable 10.2% annualized return, right in line with the historical market average. But in the high case, if they can beat those expectations and grow closer to 17.6%, then the company's operating leverage really starts to kick in. What do you mean by operating leverage? It means that as revenue grows, their profits grow even faster because many of their costs are fixed. So each additional dollar of revenue is more profitable than the last. When that happens, sentiment improves, the valuation multiple expands, and you're looking at a very attractive 17.1% annualized return. So the crucial point here is your future return is highly dependent on whether their growth stabilizes at this new lower rate or if they can somehow reaccelerate and prove all the bears wrong. Okay, we have laid it all out. The solid foundation of the business and the deep cracks running right through the stock's narrative. We've analyzed the numbers and we've dissected the fear. It is time to bring it all together, weigh the evidence on both sides, and deliver a clear takeaway. It's time for the iron verdict. It really all boils down to this one core conflict. The bull thesis is simple and powerful. You have a structural leader in a massive, growing industry. They have elite profitability, an incredibly loyal customer base, and a fortress balance sheet with absolutely zero debt. The business itself is fundamentally sound. But the bear thesis is equally compelling, and it's all about the narrative. You have a broken story, damaged by slowing growth, C-suite instability that spooks institutional investors, and a wave of Wall Street negativity. The fear is that this narrative risk will continue to suffocate the stock no matter how good the underlying numbers are. So we leave you with the ultimate question. After seeing all the evidence, is the 77% collapse in the trade desk stock a sign of a true crisis? The moment a Titan's armor has finally buckled under the pressure of a slowing economy and internal turmoil? Or is this immense market fear the very fire that forges a generational buying opportunity in a best-in-class company? The numbers say one thing, the narrative says another. Your decision really rests on which one you believe will win out in the long run. Thank you for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.